Hello, Wisconsin, and welcome to this week's edition of the Elite Money Market Update, brought to you by the team of Elite Retirement Group. I'm your host, Kristen Oakley, and joining me in the studio, we have Patrick Marcel. He is the founder and CEO, and financial advisor, Victor Kijewski. And if you've ever wondered how you can lower your tax burden in retirement, you are not going to want to miss today's show. Patrick, Victor, it's great to be back with you. How are you this week?
Doing good. Weather's good. Healthy.
Yeah, well, they can't ask for much more than that. I haven't hurt myself. So there we go.
Hey, we're celebrating all the things big and small this week, right?
That's right. Yeah,
well, I always love you guys put so much passion into each one of these shows, and you like to have a lot of fun, and that dynamic really shows up in the two of you and your relationship too, which I think is really special.
Yep, he's just like a kid. Once in a while, you got to slap him around a little bit, keep him in line.
Well, I don't know about
we
that.
like to joke around a little bit.
And you get to keep him in line too, right?
Sometimes,
it's a full-time job. Trust me, I know.
Right.
All right. Well, we have a very important conversation today regarding your taxes in retirement. You know, nothing is more frustrating than working all these years, putting your hard-earned money away, only to see that money and your wealth eroded by taxes. So the title of today's show is How to Remove Your Wealth from Washington. Wouldn't everyone like to know how to do that, right?
Yeah, send it to somewhere you really want it to go.
Yeah, exactly. Have it working for you, right? Not for them. So let's talk about that, because there's a lot of different types of income out there that is non-taxable, and we're going to get into that today. But there's so many rules, there's so many regulations. The rules are constantly changing. One of the things that you and the team of Elite Retirement Group are really stay on top of the legislative changes that are happening and what that means for folks from a tax perspective. Talk a little bit about how you're able to stay on the front lines of that information.
Yeah, so Victor just says, Patrick, look it up, and then I just look it up. No, it's actually, I'm really passionate about it because every time that I work with somebody, if I can find ways for like you to be able to save money and have more money in your pocket at the end of the day, it's not about cheating the government. It's about paying your fair share, but don't pay more than that. That's really what it comes down to. So I'm really passionate about trying to find ways to help people save money. Obviously, at the end of the day, we're not accountants. We're not here to give you tax advice. But you know what? We're a lot like, you know, the head coach, right? Mm-hmm. We're going to send we're going to send the play in, and we're going to have the line run it, and hopefully it pulls off right. Mm-hmm. And you know what? At the end of the day, sometimes we have to bring in specialists like accountants.
Well, you're not accountants, but you're tax planners. You look ahead to the future, right? To really help to see how folks can save on taxes, specifically in retirement. Why would you say it's so important for folks to pay attention to their potential tax bill in retirement?
I think it's one of the most important things in all of retirement planning, because what I tell people is when you retire with a business partner, and that business partner is the United States government. Mm-hmm. We don't know exactly what taxes are going to look like 10, 20, 30 years down the line when you're going to retire. What we do with people that come into the office is look at taxes from a macro perspective. So there's really two ways to look at taxes. The first one is through a micro perspective. An example of this, just for the audience at home, think about this in your head. Come tax season, do you gather up your W-2s, 1099s, income statements, give it to your accountant and say, give me the biggest refund possible? If that's what you're doing at home, you need to stop immediately. What you have to do is take a step back and look at taxes from a macro perspective and say, okay, how can I save as much tax over my entire lifetime as possible? An example of this, you know, my wife is staying home with the kid now, which is amazing, but she had money left in her retirement account from when she was working. It was about $30,000. So next year, we're going to convert all of that money from her 401k to a Roth account. And yeah, that's going to be a tax bill up front, but 20, 30 years down the line, we're not going to have to pay any tax in retirement. Mm-hmm. So I really encourage everybody at home to take a step back, not just try to get a big refund every year, and look at how you can save as much tax over your lifetime as possible.
Right, and that takes strategy, it takes planning, it takes looking ahead. There's so much that goes into making sure that you are creating greater tax efficiency throughout your full life into retirement. Mm-hmm.
I think another thing that sometimes people make a mistake is they think, well, I'm too far down the road. Mm-hmm. I'm too old. I can't do anything about my situation. You know, and Victor's situation is great. Mm-hmm. He's got a lot of time to work with. But even if you don't, think about this. There's a good chance the money that you've saved you won't spend that, right? So that's going to go to your kids or grandkids. It's going to probably go somewhere. We probably really want to see that money go as tax efficient as possible, and that's really why we do the planning we do as well, because it's not just your lifetime, and there's no such thing as too late. We have folks that are in their 80s doing Roth conversions because it makes sense.
Yeah. For sure. Well, we're going to talk more about these Roth conversions, but I want to go back to something you said, Patrick, that it's not about tax evasion, right? Let's be clear about that. We're not saying don't pay what you legally owe, but we want you to pay the least amount that you are legally required to pay. And we always say this too with taxes. It's almost like everyone's playing a game that they've never been given the rules to. So inadvertently, folks can often pay a lot more in tax than they're even required to, and that's what we want to help try to avoid. So with today's show being called How to Remove Your Wealth from Washington, let's look at some of the types of non-taxable income. And of course, top on the list, we've got to talk about it, those Roth accounts.
Mm-hmm. Yeah, the Roth accounts are really great because you can put money away for your retirement, or you can take money that is already set up for your retirement, but not yet taxed, make it tax-free forever, not only the money that you convert or contribute, but the gains and earnings tax-free forever. And really, what we like to think about when it comes to the Roth IRA is we want to think about how we are going to use that money in our retirement. And really, we look at it in two ways. If you have a big purchase that you need a lot of cash for some reason, Roth can be really great because it's not going to create a bunch of extra taxes anywhere else. It's not going to create taxes on your Social Security. It's almost like it didn't happen. It's almost like you reached in your pocket and you just pulled cash out and you're like, here, I got cash to pay for it. It's really awesome that way. Another reason that we really like Roth money is that we think about when a spouse passes. And I know we've talked about this before, Kristen, you and I, about when a spouse passes, a lot of times we're not thinking about how that impacts that person that's surviving. That person that's left behind won't have a huge decrease in expenses, but they're going to have a huge increase in taxes because all the tax brackets basically go in half. And that's a really big deal. So the Roth IRA can help with that income. It can buffer that a little bit. I look at it that way. And you can build some of your income with tax-free and some with taxable, and then at least keep the taxes at bay.
Well, there's probably two kinds of people watching this show, right? You've got folks out there who have had a Roth account. Maybe they have a Roth 401k option. Those are increasingly becoming more available. So, folks can take advantage of those. But I know that the majority of Americans have the bulk of their wealth saved up in these tax-deferred accounts, these qualified accounts. So, traditional IRAs, 401ks, 403b, whatever employer-sponsored plan you have. You mentioned the story of how you're even doing this with your wife's old 401k, converting it to a Roth. Spell out in a little more detail who is an ideal candidate for a Roth conversion, how that actually works, since so many folks are in that position where they're like, yeah, I'd love to convert what I have into a Roth.
Absolutely. So the ideal candidate can really be anybody. It just depends on your situation. But when we talk about Roth conversions, how they actually work is, let's say you retire and you have a 401k, you have $500,000 in that 401k. All of that money is going to be taxed. And I think that's really the biggest problem with most people before they retire is they have all this money in tax-deferred accounts, meaning they haven't paid a penny in tax yet. So what we try to do at our office is get money out of that account, pay the tax on it, and put it into a Roth when it makes sense. So how that works is we sit down at the office and we go through what's called tax bracketology. We figure out where you fall within the income tax brackets and then see if it makes sense to do that conversion. Because when we do that conversion and we pull money out of a qualified account like a 401k, it counts as income and you're going to have to pay federal and state tax on that money. But the benefit to that is once we get that money in the Roth, it is tax-free forever and you never have to worry about what the government does with taxes, your tax situation. Because when you pull that money out, it's all tax-free forever. But from an ideal candidate standpoint, what we like to do is go over tax bracketology at the end of every single year for our clients. Some years, if you make a lot of money and you're in a higher tax bracket, it might not make sense. But a lot of years when people have room left in that 12% tax bracket, it makes a whole lot of sense to pay 12% tax, especially if you look at where taxes are right now. Historically, taxes are extremely low. So if you think you're paying too much in tax right now, you're probably mistaken, because if you look back out throughout history, they're pretty low. So we really have to take advantage of where tax rates are at right now.
For sure, and this is why this is such a time-sensitive conversation. Talk about the current tax codes going to sunset. What does that mean for folks right now with this?
Well, you definitely want to take action. You don't want to really put this off any more than you have if you've done that. Because in 2025, the current tax law is set to expire, which really what that means is that it'll go back to 2016 levels. So when we look at the standard deduction being nearly $30,000 for married filing joint, it's going to drop all the way back to where it was before, and I believe it was around $12,000. It was very low, what the filing joint deduction was, plus your brackets come down, 12% goes to 15. It's just a whole plethora of things. Now, some of the other things I think that we want to address at some point too is what are the potentially proposed tax law changes?
Right.
I've been reading quite a bit about that, and there's some things in there that no matter what anybody says, it's going to impact all of us. It's not going to be just the uber wealthy paying taxes. We're all going to get hit.
Right, and this is why you have to be prepared and have a plan in place.
Yeah, and just to piggyback off that a little bit too, come 2026, if the government decides to do absolutely nothing, that sunset's going to end and taxes are going to revert back to where we were in 2017. If you look at the numbers, that's about 11 to 12% increase across the board. So just be prepared for that. If the government does nothing and the sunset ends, you're going to be paying a little more in tax come that time.
Right, for sure. Well, clearly there's never been a better time to have a plan in place. If you are out there and you're wondering how can you remove your wealth from Washington rather than just settle for the plan the government has for you, if you would like a plan that can show you how you can potentially eliminate and reduce your tax liability in retirement, then we invite you to pick up the phone and call 833-856-1392. For no cost, no charge, no obligation, you'll be able to come in and meet with a member of the team from Elite Retirement Group and receive your very own complimentary written financial plan. If you'd rather not talk to someone right now, but you do have your smartphone handy, you can simply pull it out. If you open up that camera app, you can point, click, and scan the QR code down in the bottom right-hand corner of your screen. That will take you over to a landing page, ask you a few short, simple questions, and then a member of the team will reach out to connect with you to schedule your time to come in and receive your complimentary written financial plan that way as well. More on this conversation of how to remove your wealth from Washington right after this.
I was around 6 years old, and I went to the bank with my mom, and she showed me how there was money that she deposited, and then there was another line that had money on it. And I said, well, where'd that come from? And she said, well, the bank gives you money to have your money here. A couple years after that, I saved up some money from my birthday, and I opened the phone book, saw there was a broker, called them, and of course, like 8 years old, you can't invest. So, but I wanted to, and I thought there would be a tremendous opportunity to have my money make money for me. I didn't think I was going to be doing this per se for a career, but then I actually was laid off from a job I had in the laser industry. My father-in-law actually had a business in finance. He met with me, came over, and he said, well, hey, I'm just gonna tell you what I do, and you can do whatever you want to do. So I went and I did an interview when I lived in Eau Claire. The owner of that firm, or ran that firm, he said, you're not really qualified for this. I said, no, I'm not. But you know what? You're an Eagle Scout. And there's one thing I know about Eagle Scouts is they stick to things. So I'm going to give you a chance. So then 2016 came along. My father-in-law said, it's time to retire. I purchased a business from him, and we've been running it since then. My wife is part of the project, and my brother's part of it as well. So we still keep a lot of family involved in this business, and it's been a good ride.
Welcome back to the Elite Money Market Update. I'm your host, Kristen Oakley, here with both Patrick Marcel and Victor Kijewski from Elite Retirement Group, based right here in Wisconsin. The title of today's show is How to Remove Your Wealth from Washington, and we are working through a list of the types of non-taxable income, all with an effort to help you keep more of your hard-earned money to make sure that you don't have to pay any more than you are legally required to pay to the IRS. And, I want to go back to something we were talking about. This is a really timely conversation because of where tax rates are right now. A lot of folks are saying tax rates are on sale because the current tax code is set to sunset at the very end of 2025, right, which we talked about, which means at the beginning of 2026, if Congress does nothing, tax rates are going to go back to what they were previously in 2017, and they will go back up. So let's talk now. I know we talked about Roth conversions and why that can be a really powerful strategy for folks to help remove their wealth from Washington. Let's talk about financial gifts, because that's another avenue that folks have available to them.
Yeah, so gifting is another way that you can move some of your assets to another party without having to pay taxes. And part of what I do in my free time, which I don't know that I have a lot of free time, but I'm a member of the board of directors or executive committee for the for the Boy Scouts of America, San Jose Council. And what we do is we encourage a lot of former scouts to gift stock or give gifts to the charity, and they can do it on a tax-free nature. So that's something that's really beneficial, really helpful. But the other thing too is when we look at giving money to kids, to family members, you can give $18,000 per person. So if for my son Logan, if my wife and I were to give money, I could give $18,000, she could give $18,000. Now, it's not taxable to Logan, but if I'm pulling that money out of my IRA to give to Logan, I have to pay taxes on that IRA. So it's another way we can transfer some of that wealth now. We can get it over to our kids in a way that we know where the taxes are at, what the rates are at, because maybe my tax rate's lower than my son's tax rate.
Right.
And maybe that's something I want to do.
So the gift tax limit, it was raised for 2024. It's now $18,000 per person, right? So that's important to know. You mentioned about giving to charity. So Victor, let's talk about charitable giving, because that's very different than giving financial gifts to family members. There's things such as QCDs, those qualified charitable distributions. Talk a little bit about how that can be a tax saving strategy.
Absolutely. So eventually, when you get into your 70s, and it seems like the required minimum distribution age is continuing to change, but at some point the government says with this qualified money that you have, you're going to have to take it out because they're going to want their cut via you paying tax. One thing you can do with your required minimum distribution is donate that to a charity. That way you don't pay any tax and the charity doesn't pay any tax either. But again, how the required minimum distributions work is once you hit that age, you add up all of your qualified money you have, multiply by the age factor, and that's the amount you have to take out of those accounts. I'm actually going through this with a client right now who has a pretty big nest egg for himself, but all of his money is in this tax-deferred qualified account. So he's going to have to take out about $70,000, and he doesn't want to. But if he donates that to a charity, he's not going to pay any tax, and then that charity is not going to pay any tax. So once you hit that 70 age, it's really important to start planning for that and understand how you can save on taxes from a charity donation standpoint.
And it's really a win-win. It's a win-win for you as the person who's making that donation, right? Because you get, you don't have to pay tax on it, and then the charity receives the full amount. The key is, though, you don't want to withdraw the money, then give it to the charity. That's not what a QCD is. It has to go directly from your account over to the charity. So I know you all help that happen for your clients who are interested in utilizing that strategy.
And that's another thing that could change if the current tax law sunsets. Because now you might go back to itemizing versus just taking a standard deduction. And really with the standard deduction going up so much, that's why a lot of people have turned to the QCD because it's easy. I still think it's a great strategy. It was always there before, just underutilized. Now more people are aware of it, and it is a really great way to get money to the charity of your choice. Absolutely.
Well, moving on down this list that we have of non-taxable income, next up on the list is life insurance proceeds. Talk about those.
Yeah, so life insurance is a great way to be able to take a smaller amount of money and be able to leverage it into a tax-free benefit for beneficiaries. So when we're saving and building for retirement, our life insurance needs, they take on a certain meaning, and that is to play the role of paying off debt, right? So our family's not left with a bunch of debt if we expire early.
Right.
When we get to retirement, life insurance takes on a totally different meaning. And what I look at is that really at a very, very minimum, we should own some life insurance, and I always recommend at least $50,000 to, I call it throw the dirt on me insurance. It sounds crazy, but a small amount of life insurance that my family will get when I pass away, they'll have it tax-free, and they can use it for my final expenses. And I think it's a really great way to look at it because you don't want to have to sell. If I die and our investment's in the market, maybe the market's down, and my wife, I don't want her to sell some of our positions at a loss just to pay for the funeral. I don't think that makes sense. The other thing, too, is that I don't want to have a benefit to pay my bills either. So I just want to kind of make sure I'm controlling my own destiny, and I think that's really, really important. Life insurance, there's some other applications as well. When we start getting a higher net worth, you know what? Maybe we want to try to help our kids pay some of those taxes. You know, if you said, you know what, Kristen, you're going to give me $50,000, and I'm going to give your family $150,000 tax-free, that's a pretty good return on your investment, right? And that's really how you have to think about it, is that it is a return on investment when you get into retirement, and it's something you want to set up early.
Right. Yep. Well, speaking of insurance, there's also long-term insurance income. So talk about that, Victor.
Yeah, absolutely. Long-term care insurance, different types of policies you can take out. There's really 3 ways to plan for long-term care insurance, and that's through long-term care policies, life insurance, and then alternative investments as well. But depending on how you set up your long-term care policy, if you do go into a nursing home or a long-term care facility because you can't perform 2 of the 6 daily living activities, a lot of the time your payout from that policy is going to be tax-free if you use it for your long-term care needs. So it is a great way to kind of plan for the end period of your life where, 7 out of 10 people are going to need some type of long-term care. So it's important to plan for that too, and you might as well do it in a tax-free manner.
Absolutely. Well, gosh, so many options are available, and I know we've only scratched the surface. We have some more solutions for folks. So if someone's watching today and they're going, you know what, I've never even had these kinds of conversations. I've heard this a lot. Sometimes folks have been working with a financial advisor for a long time, and they've never had any of these tax planning conversations. Do you find that that's the case a lot of times when folks come in and meet with you for the first time?
Yeah, actually, it's pretty unusual. Somebody comes in that doesn't have a financial planner currently. A lot of times people will say, I already have somebody. I don't need. Well, here's the thing is that you don't know what you don't know.
Right.
And if you found out something was wrong, how soon would you want to know it's wrong, and how fast would you want to fix it?
Right.
And that's the reality of it is, and we say it all the time, Kristen, you and I, that you can't get the second opinion from the person who gave you the first. So I think this fallacy of I have a person, I don't need to check around, is a little bit lost. I think that's not a great strategy. Getting another opinion, having somebody go over things, most of the times, folks don't have a complete comprehensive picture.
Right.
So we do something called a deaccumulation part of the written strategy. And we go through the tax side of it and looking at maxing your brackets, looking at Roth conversions, looking at what assets you draw at what time. It's really, really important for you to have a really sound strategy going to retirement because, hey, you worked really hard to get here, right? You're ready for retirement. This could be the next 20 or 30 years of your life, and you got to get it right. Why not get a second opinion?
Absolutely. So I think the bottom line, especially when it comes to tax planning, is if you're already working with someone else and they are not having these kinds of conversations with you, it's time to get a second opinion. And the beautiful thing is it costs you nothing. We invite you to pick up the phone and call 833-856-1392 to receive your very own complimentary written financial plan from Patrick and Victor and the team of Elite Retirement Group. Or again, you're welcome to scan that QR code and that will get you connected as well. More on how to remove your wealth from Washington right after this.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Welcome back to the Elite Money Market Update, where today we are discussing how you can remove your wealth from Washington. I'm your host, Kristen Oakley, with both here Patrick and Victor from Elite Retirement Group. We've been working our way through a comprehensive list of non-taxable income. Of course, we could talk for hours on this subject, right? I know you're so passionate about helping folks have a solid plan in place, specifically for taxes and retirement. I want to ask about one of the items on here of non-taxable income is some capital gains and losses. Talk about those, Patrick.
Yeah, actually, it was really interesting. Recently, I had a client call up. They needed some money out of one of their accounts. So I was looking over their accounts and I said, hey, you have this stock that they've had for a long time, but it's done very, very poorly. They had it even before they came to us. And I said, if we sell some of the shares here with this and take some of the loss, and we sell some of the gain here, we can wash it out. And we can take that money out tax-free.
Right.
So that was a really nice strategy, but I think when we look at capital gains, there's a certain amount of capital gains that you can have as well and not pay any tax. I know my brother and I, we've been actually 2 separate cases. This is really interesting, where we had clients that had a lot of company stock. And they retired, and instead of just rolling the money over into an IRA, which would have been a mistake, we decided to roll over the stock or roll out the stock and do what's called NUA, or net realized appreciation. That is a way for us to be able to pay the tax on the stock as capital gains, not as ordinary income, as if it were coming out of the IRA. So that's a really, really effective strategy. And basically, at the end of the day, it's a great time to do that right now, because some of the proposals that I've been reading about is looking at capital gains rates doubling.
Wow.
Which would be huge. Taking away the step up in basis. Those are some of the proposals that the current administration are putting forth for the replacement of the current tax law. So let's get at it, let's get planning, let's get a game plan together.
Yeah, it just speaks to, we never know what's going to happen in Washington. It's called legislative risk. We're all subject to it. This is why you want to get in front of it and have a solid plan in place so that if these changes happen, you can then know what you need to do, right? I mean, so many folks are floundering, I think, right now with taxes and paying way more than they need to just because they simply don't know.
Yeah, absolutely. And I think because we don't know what's going to happen in Washington, it's super important to have diversification within your taxes. You know, we always talk about diversification with our investments, stocks, bonds, mutual funds, ETFs, annuities, whatever it is. It's the same thing with taxes. We need to have money in our tax-deferred bucket, our tax-free bucket, and our taxable bucket, because if we have that diversification, we don't really worry about what Washington is going to do in the future, because we know we have different options to pull money from. Right. Obviously, having all of your money in a Roth bucket would be great, but that's just not realistic.
Right.
So the goal is to, again, have that diversification. And the problem is, when most people retire, all their money is locked up in these 401ks, 403bs, where they have to pay all the tax on it. And if taxes go up in the future, they're just going to be subject to whatever changes. So having that diversification is really key for retirement.
For sure. Well, I know we have only a minute left on today's show, but when someone calls and comes in to receive their complimentary written financial plan, from a tax perspective, what kind of information are they going to be able to walk away with about their situation?
Yeah, so one of the things that I really like doing, because I really, really like spreadsheets, is we have an amazing spreadsheet program that will actually be able to take your information from last tax year. We'll be able to put it in, and we'll see exactly how much we can convert, and if we convert, how much it'll cost in taxes. I think that's really, really huge. So that's part of the written plan as well, and really, the written plan ends up being what you make out of it. The more information you help us with, the more information we can give back to you. And again, remember, this is our way to be able to just audition to be your financial advisor. And if we're not the right fit for you, that's okay. Just let us know, because at the end of the day, we want to provide you with an excellent plan, something positive you can walk away with, because this, for us, is a long-term relationship.
Wonderful. Patrick, Victor, thank you so much. Always a joy to be with you. Thank you for joining us again on this conversation of how to remove your wealth from Washington. We look forward to being back with you next time. Be educated, be empowered, and most of all, be prepared.